Welcome back to our YouTube channel, your go-to destination for holistic growth. Today we will decode for you which investment vehicle you should ride to reach your financial goals, ETFs or mutual funds. As you already know, in the vibrant world of Indian finance, two investment vehicles stand tall: exchange-traded funds, also known as ETFs, and mutual funds. Both command attention from beginners and veterans alike, but which is the better choice for you? Let's dive into the nuances that govern these investment vehicles. So buckle up as we dissect, compare, and ultimately determine who wins the crown in this financial duel. From taxation to performance, liquidity to cost, we're covering it all. By the end of this video, you'll not only grasp the fundamental differences, but also be equipped to make informed decisions for your investment strategy. So, let's unravel the mysteries of ETFs and mutual funds. Segment 1. Understanding ETFs and mutual funds. Let's start with the basics. ETFs are akin to stocks and trade on stock exchanges like the Bombay Stock Exchange or the National Stock Exchange, holding assets such as stocks, commodities, or bonds. They are known for their market-like liquidity and real-time pricing. Mutual funds gather money from many investors to purchase a diversified portfolio. Unlike ETFs, they are not traded on an exchange, and their value is determined at the end of each trading day based on their net asset value, or the NAV. Segment 2. Feature-by-feature comparison. Now, let's pit them against each other in a feature-by-feature showdown. Refer the comparison table on your screen. This comparison table sets the stage, but the real impact comes from how these features affect you as an investor. So, let's dive in. A. Trading and pricing. First up, let's talk about how you can buy or sell ETFs and mutual funds. ETFs are cool because you can buy and sell them like stocks, anytime the market's open. This means if you see a price you like during the day, you can jump on it right away. Mutual funds are a bit more laid back. Whatever time you execute the purchase or sell order, it will be processed at the end of day's net asset value. In India, currently the cutoff time for mutual fund orders is 3 p.m., and orders placed after 3 p.m. are processed on next day's closing NAV. B. Costs. Expense ratios, bid-ask spread, costs and brokerages. Moving on to costs. Yes, the not-so-fun part. Though, ETFs generally have slightly lower expense ratios, which means they cost less to manage compared to mutual funds with the same portfolio. But ETFs come with paying brokerage charges to your broker, and are also susceptible to leakage due to bid-ask spread costs. The bid-ask spread cost is specific to ETFs only, and refers to the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. The bid-ask spread and brokerage are the costs you incur every time you trade in ETFs, so if you're trading a lot, it can add up to a lot. If you are buying and selling ETFs which have less volume and liquidity, the bid-ask spread cost can turn out to be very significant. So, on one hand, mutual funds have a higher management fee, but they also save you from the brokerage charges and the potentially hefty bid-ask spread costs. C. Tax efficiency. Now let's unravel the tax threads, something we all care about. Both ETFs and mutual funds are pretty tax smart. In both cases, be it ETFs or mutual funds, you only pay capital gains tax when you sell and make a profit. For long-term holdings in equity, if you stayed invested for more than 1 year and if your long-term equity capital gain exceeds rupees 1 lakh in the financial year, you're looking at a 10% tax on the gains, without indexation benefit. Not too bad for letting your money grow. D. Tax harvesting. And the fun part, in both ETFs and mutual funds, if the realized long-term equity capital gain for the financial year is below rupees 1 lakhs, then the entire gains are tax-free in your hands as per current tax laws. Many retail investors take advantage of this feature by booking long-term equity capital gains just below 1 lakhs in a financial year. This is also known as tax harvesting. To explain this in simple terms with an example, assuming the same tax laws remain for next 5 years, it will be beneficial for you to book rupees 1 lakhs long-term equity capital gain every year for next 5 years and pay no tax instead of booking rupees 5 lakhs in long-term equity capital gains in one go after 5 years and pay a hefty 10% tax on rupees 4 lakhs capital gain, assuming your 1 lakh out of the 5 lakh booked long-term equity capital gains in a financial year is tax-free. E. Management style and liquidity. Style matters, right? ETFs are mostly passive, mimicking the moves of an index, which means less tinkering from fund managers and typically lower fees. Mutual funds can be either active active, where a manager is trying to outperform the market, or passive. So, more choices, more flexibility with mutual funds. F. Settlement of funds. If you need quick access to your money, ETFs are there for you since they trade like stocks and the money is settled on a transaction date plus 1-day basis, whereas equity mutual funds take a bit longer, usually 2 days after the transaction date, to get your funds in your bank account. G. Investment choices. Both ETFs and mutual funds offer a wide array, anything from stocks to bonds to gold, and they're both very versatile. And there you have it, friends. A rundown of ETFs versus mutual funds. Whether you like the fast pace of the stock like ETFs or prefer the steady strategy of mutual funds, the best choice depends on what feels right for you. In the Indian context, personally, we feel that one can go for ETFs, for highly liquid ETFs, Life the Nifty ETF. But when it comes to most other ETFs, where liquidity and volume is not as high as, say, a Nifty ETF, mutual fund might be the right vehicle to ensure efficiency and that you do not lose out on net returns because of heavy bid-ask spread costs. I hope this breakdown helps you feel more confident about making the right choice for your investments. If you learned something valuable in this video, then say it by hitting the like button, subscribe our channel, and share the knowledge with friends and family. And hey, do leave a comment if you have more questions or just want to chat about your learnings. Until next time, stay safe, stay healthy, and happy investing.